Hi, thanks for joining our podcast today. I'm Matt.
And I'm Mike.
Glad to have you with us. Glad you're joining us for Where Credit is Due. Really, it's about giving credit where it's truly due. And we're just excited to be able to sit and chat with you about a bunch of topics. And today's episode, number one, and our first episode, is the state of the commercial credit risk industry, particularly, obviously, 2025. Mike, what do you think about it?
Well, Matt, I've thought a lot about this, and quite frankly, I think we're in uncharted territories.
And why?
Well, why? Great question. I just think that, we've had many years of what I'll call benign activity. We went through a pandemic. There was no bankruptcies. Companies that probably should have went under didn't go under. Again, there was all kinds of money. And now we're looking at what's going on. And you can tell by the number of bankruptcies that are occurring, especially this year, they're up significantly. There's actually 694 bankruptcies, large companies, year to date through September, versus 2024, there were 510. So the first question I have for you, Matt, is what do you think the number of bankruptcies will be by the end of the year for 2025? It's your guess.
Sounds like we got a little side bet going on this one, Mike. Personal feeling, just watching some of the behavior of activity. I'm going to go with 950 large business bankruptcies by the close of this year.
All
What do
right,
you
I'm writing that down. 950 for Matt.
think? Pressure's on.
I'm going to go with 840 for
Oh,
Mike.
so you're a little more conservative than I am. That's
Well,
different for us.
let's put that in context to 2009, at the height of really the downturn from the banking crisis. There were only 242 large bankruptcies. So
Wow.
that to me, that's what keeps me up at night and wondering how can we help folks better understand the lay of the land that's out there. When you think about the big picture, with interest rates up, they're trying everything. Maybe the Fed will cut another quarter point, maybe a half point by the
Yeah.
end of the year, but clearly up, and the cost of capital, especially for risky accounts, is growing. The fact that there's no such thing anymore as covenant light. So everything that's being renegotiated has much higher table stakes than what is coming due and going into the back burner, so to speak.
Yeah, I think you nailed it. What's coming due, right? Like what's in front of us? That's the real big question. We just shared the metrics, right? I mean, obviously things aren't as good. What we didn't share are some of the micros. You just shared some of the macros. What about like micro stuff, even just at the foundation where we see like CEI, collection effectiveness? I mean, year
Yeah.
over year, that is way down. DSO numbers can up considerably year over year. And even if you get it even the real micro, right? In the portfolios in general, forget what industry it is, just in general, percent current is way down. It's just not where it used to be. So it's the macro and it's the micro activity out there. I think it's really driving, some of these thoughts. And I agree. I think we're in for some uncharted water, not only through Q4. I think we're in for a little bit of a ride for this industry and this discipline across the board. You talked about interest rates, you talked about inflation. There's the defaults going on. We didn't even get into the whole geopolitical type of scenario yet, which has got a lot of people on edge these days. What do you think about some of the latest news, like the latest bankruptcies out there? I mean, like Rite Aid, right? Just liquidating at this
Yeah,
point.
I mean, think about Rite Aid, 3,900 stores. And quite frankly, actually, yesterday or today, they just announced that they're closing the rest of the stores. So now they did sell a number of them to some of their competitors, but that was almost 4,000 stores across the country. And they no longer are, they're going to cease to exist
Right? At one point, the largest U.S. pharmaceutical retailer,
in the
and
country.
now cease to exist at this point.
Now, I
Yeah.
think there's a couple of points with them, just in terms of how most people get their drugs today, in terms of having a 90-day subscription so they don't go into the front end of the store. Front end of the store had higher margins with a lot of the things that people would pick up as they were getting their prescriptions. That kind of went away. Not to mention the Amazons and Walmarts of the world that have just really upped their game when it comes to having things delivered to your door. So again, there's an exodus of what I'll call the bricks and mortars, which impacted them. But there's another bankruptcy that just occurred, which is kind of, I've actually read where someone said this could be the canary in the coal mine.
Uh-oh.
And
All right, who do you have?
the name of the company is called Tricolor, and it's the seventh largest used car dealer in the USA. And what's really, really concerning about that one, Matt, is that they're not filing for Chapter 11 reorganization. They actually filed for Chapter 7 liquidation. So the first question you have to ask yourself is, why would an account like that file to liquidate? Because all of their loans are based on the security with the vehicle that they sold.
Yeah. But Mike, we're not talking new cars, right? We're talking the used car
Yeah,
market,
this is
right?
used car.
This is, we're not, we know all know used car prices today and where they are. New car prices, a used car generally a little bit less or a lot less.
Oh yeah, and you could probably call it a bifurcated economy. There's clearly lower income, and I'm sure this particular company catered to those folks. But I also think we're going to find that there are some shenanigans going on within the company and actually using collateral multiple times for their loans. So I
Mm.
think that's going to be another big driver of, again, why they would file for Chapter 7 versus being able to reorg. Because again, assuming the vehicles are out and about, you would think they would be able to pull those all back in for those that aren't paying and repossess those vehicles. But
Yeah.
those are concerning things happening. You got your largest, drugstore, you've got a super large used car dealer. There's 692 others we're not talking about that filed. And we're talking large bankruptcies. So, I think today, more so than ever, the credit professional has an opportunity to shine like no other. Again, I like to always say a credit person is worth their weight in gold. And you're talking about gold, that's another fear indicator, pushing $4,000 an ounce, Matt.
Who would have thought, right? 10 years ago, gold would be $4,000 an ounce. Even
An
even 2 or 3 years ago, it just continues to go up. That's one of those things that keeps me up at night a little bit, right? Like people moving into that because
Yeah.
it's a sense of security away from the general investment markets. And another thing, right? Like I'm going back to the Tricolor bankruptcy, right? And I'm thinking of putting my credit practitioner hat on right now and thinking about what you just said. They were using the cars that they had secured in those loans multiple times, right? So they securitized that asset multiple times. If I'm thinking about the general market, my other customers out there or my portfolio, boy, that's something I really need to think about and make sure my customers aren't, multi-securitizing, if that's the right phrase, the assets that they have. I got to be really diligent when I'm looking at those bank loans that they have and pushing that through to their customers. What are they doing with their customers as well? But it's just something else that you have to think of as a credit professional these days. What else? What keeps you up at night besides some of that?
Well, again, I think you touched on due diligence, right? And know your customer. I think that's so important today, whether it's a new customer or ongoing. Because things happen so quickly anymore, the only thing constant is change.
Oh
But the
yeah.
rate of change just continues to exponentially grow. And then, you have all this technology that can allow you to do things so much quicker and faster. It's really being able to monitor the portfolio, and if there's a past due trend, going back to Matt, some of the micros you talked about with DSO, or if you're over 90 and over 60 spiking, and there's a number of accounts in a particular industry, that's what you got to be looking at to understand where you need to be talking with your senior team about things that are trending negative and that haven't really happened in the past. I think there's just a lot of tools out there that can really help you better manage the portfolio.
I agree. Let's stay there for a second because I think it's part of the key to success right now is there's so much information. How do you absorb it? How do you digest it? How do you utilize it to your benefit? And you have a portfolio of customers, and some have smaller portfolios than others, but you need visibility into that portfolio, right? How do you know which are the good customers and which are the ones that may be riskier or those that are not profitable, those are profitable for you? I think that segmentation approach to the portfolio is really key. And you can be very sophisticated and have great tools out there that can help do that for you. But even if you don't have the ability to purchase some of those tools, I think even using an Excel spreadsheet, segment your portfolio,
Oh,
understand
yeah.
who are your high risk customers, who are your low risk customers out there, who do you have great gross margins on or high gross margins, who do you have less on, and start to figure out what's your approach on those as you go forward, and then monitor them appropriately. Your high risk, maybe even I'm starting to put my medium risk guys into that list now, just because of what's happening in the cycle times that you talked about. I'm certainly hitting those more often than I probably did 5 years ago, 3 years ago. And I'd suggest you probably look at those folks certainly monthly at this point, not even yearly. That's even off the table. Whether it's monthly, some of them maybe even daily, given the activity that's out there. But yeah, I mean,
I can tell you've
keep
been a
an eye on it.
practitioner as well, right?
Yeah.
No, I said you've been a practitioner, and I think segmentation today is so important and making sure that you have your high risk accounts categorized. And again, if you've got some strategic accounts that are high risk, you've got to have a seat at the table with your organization.
Yeah, it's key.
A credit person makes a decision on with less than perfect data. The key is you've got to use data and take emotion out of a conversation and just share what it means to the organization from a risk perspective, a margin perspective. There's always a relationship. But at the end of the day, if an account's going to file for bankruptcy and you've got millions in there, you know, chances are if they do file for bankruptcy, you're going to be dealing with new people on the other side of the bankruptcy.
Hmm.
So
Yeah.
again, the relationship is important. I want to impress upon everyone that it is. But in the same respect, if you lose millions of dollars to bad debt expense, that could really have a significant impact on the organization that you work for. The objective, of course, for credit professionals is to make sure that you're proactive in your risk assessment and you are on top of it and you are telegraphing to your key folks within the organization. They may veto your recommendation. That's okay. But you've
Yep.
been on record that said ABC company is going to go under. We've got 3 million outstanding. We should mitigate. And again, that's all you could do. But you got to have that conversation. Because what you don't want is some Monday morning where you get a phone call from the controller or the CFO and says, hey, ABC company, why weren't we talking about this? I just saw that, this morning they filed for bankruptcy.
Mike, you just hit on something. I love to make that a future podcast, right? Is how do you get that visibility? And I've always went with the philosophy that it's eyes wide open approach. And me as a credit professional, practicing credit professional, I have that responsibility to make sure that my senior management has visibility to that, right? And there's a whole approach to that. It's not one and done, doesn't happen overnight, right? It happens over time. But I really believe eyes wide open using data segmentation. And then you need to be able to align and communicate with your senior folks as you're in these times. This isn't pre times where there's plenty of money and there really wasn't a lot of default. We're seeing the default. You shared with us the number
Oh,
of
yeah.
we saw what's happening and shared with what we're seeing in our members' portfolio. So it's your responsibility to be in front of folks and figure out how to have that seat at the table with the appropriate professional voice so that you all align on the approach that you're going to take. And there's visibility out there. I mean, that's number one key I would offer to any credit professional out there is to make sure that they're doing that. It's not about just sending a report and sitting back at this point. Now it's about having that seat at the table and an equal voice in the process. Maybe not the final voice, but an equal voice as to what's happening out there that
Well,
keeps you up.
no, that's a good follow-up, I guess, for a future discussion with our friends that we're going to have here. And again, our whole objective of Where Credit is Due is to share some of the wisdom. We're going to be bringing on guest speakers and talking about different subjects. Both Matt and I think right now the biggest subject that's staring us all down is the debt that's out there. And, if there's a slowdown and we start seeing a lot of unemployment, that debt service isn't going to be able to be managed. And that's when the proverbial snowball going down the hill starts to happen. As
Mhm.
well as there's some unique industries that are more hurt than others as you're looking at, today's business environment. And you above everyone should know where your risks are. And again, we have a number of platinum partners that have incredible services that you can use to help identify high risk accounts or any changes from quarter to quarter, as well as what you and your analysts are doing to support whatever the risk is out there. So again, there's just an awful lot of opportunity for you to shine and to really be able to grow your career. For the folks that had worked with me in the past know that I used to get excited in times like now, and I guess I'm probably just a lot different than a lot of folks, but these are challenging times, but this is when you get to step up and really be able to show the organization the worth that you and your team brings to the bottom line. And you know what? You got to telegraph that. You got to share it every week, every month, every quarter, and let the organization know that you're bringing value to the business. And there's no better way to do it than making sure that you're getting credit for mitigating risk or driving working capital in a positive way, keeping accounts at terms, things like that, things that you probably take for granted. Those should be headlines.
They should be. And there's ways to do that too, right? I mean, you highlighted a bunch of things, right? It's analytics, right? And there's great tools like, the AI whole segment, and we'll get into that through our podcast. What about better covenant monitoring these days? I mean, you need to
Yeah.
be on top of that, right? Where are we going? What's changing? I think about that, the risk segmentation models. I mean, get involved with that. Get involved with peer benchmarking within your industry and maybe other industries as well to understand those best practices that are out there. One of the things I monitor that, maybe slightly different because of the role I'm in now, formerly 35 years as a practitioner, now with the Credit Research Foundation, I'm watching the behavior of folks because I don't have accounts anymore to monitor. I'm watching the behavior of folks and what are they doing? And these are credit professionals. And what I'm seeing is number one, we are seeing a big uptake in the number of classes that are being taken at the foundation. Number one is bankruptcy classes. What do I do? My customers filed bankruptcy. What do I do now? That's by all
Yeah.
means. I mean, that just took off for us. The second one that is really taking off is financial statements and that beginning to end result of how do I deal with the customer from when do I onboard them? How do I onboard them? How do I look at them? Mike, you did some great work on that and some classes that are really taking off for us. And then I watched the behavior of just some of the people around us, like the third party agencies that are platinum partners of the foundation. They seem to be really busy right now with a lot of good activity
Yeah.
in their eyes. Mike, what about the attorney class, right? The friends of the foundation. You're pretty close to those. What do you see and hear from those guys?
Well, they're hard to get a hold of, Matt. Let me tell you. We have one of the practitioners been around probably 40 plus years. And a comment last week was, I've been at this a long time and I have never been this busy in my career. And that should tell us all something that, again, there's just way too much activity going on as it pertains to defaults, bankruptcies, and as Matt shared earlier, I don't think it's going to get any better. And again, I think one of the key points is for you to be educated on what you should be doing. Matt talked about a couple of the courses. I always like to call it the arc of mitigation from customer acquisition to customer disposition.
There
It's
you
a
go.
few hours, but it will take you through everything you need to be thinking about, especially if you got new people on the team. You need to make sure that you make some time for those folks to get some training. And we're here as well at the Credit Research Foundation to help fill in some of the blanks. Feel free to reach out to Matt or myself, and we can talk about some of our experience. And if you're green and new to that world, we can help get you positioned so that, again, you become the hero.
Yeah, good advice. But I'm going to start to maybe wrap it up a little bit. I'm going to recap real quick some of the things we talked about, some of the things we would like to talk about, and then let's talk about takeaways for folks. But we started off with like the big picture, what's happening. We hit the bankruptcies, we hit the internal metrics the foundation is seeing, talked about interest rates, inflation, default activity, geopolitical, right? So we hit some of those. And what's keeping people awake at night, right? Like we talked about the risk, the customer concentration, understand your portfolio. We didn't even get into the fraud uptick. That's a whole nother topic for us, but that's certainly embedded in this whole thing. And regulatory and compliance issues that are out there. We hit opportunities, right? We talked about portfolio segmentation, utilization of AI when and where available. If you don't have it available, the old Excel spreadsheet is a very powerful tool. Talk about covenants out there, the segmentation, peer benchmarking as to what's taking place. What do you see, right? So if you wanted to take today's segment and put it in a capsule and the takeaways for folks, what are you thinking, Mike, at this point?
Well, I think you just nailed a number of them. And one of the things we hadn't talked about is networking. You
Hmm.
got to network with other credit professionals, and understand where their heads are and what they're thinking in specific industries. That could really help you as you're looking at your portfolio, and maybe there's some risks that you're not aware of that you want to become very close to, and of course, bring the senior team up with the analysis. You got to do your work with understanding your business, the margin. What does it mean? If I cut terms and they put me in the penalty box, what does that mean to the bottom line of my company? That's what you got to share with the team, because you know what? If you cut a customer, you might go in the penalty box. So what's that worth? What's the break even of if you lose sales 30% for the next 6 months? What does that mean to the bottom line versus if you just let it go and the bad debt expense was there at the end of the 6 months? Chances are you're going to be in better shape if you trim the sales, or we're able to mitigate that risk versus the bad debt expense.
Yeah, great point. And again, have a seat at the table, being able to share that proactively and upfront, not after an event, right? It's usually know it beforehand, build trust with your leadership that you're making the right decision so they value your opinion, your thoughts, and your input, and make that collective decision across the board. Again, if I would look at those individuals that I would, put up on my pedestal, those credit professionals, they were really good at communicating and sitting at that table with their senior leadership to do all those things we just talked about, right? And help your organization through these times. Yeah, certainly true. There's a lot going on. There's no doubt. We talked about keeping your risk models fresh, create visibility,
Yep.
invest in the visibility, right? And who do you invest in first? I would say invest in yourself to create that visibility. You're the best one. What else do we want to share? Any closing comments?
Well, again, this is our first one. I think one of the other key things, and it was an old boss that I had, and as we were working on what do we want to name this? What I think is really important as a leader, so this is more around leadership, is to always give credit where credit is due. And that means your people, right? The people on the front lines, the people that are doing all the hard work. You want to make sure that you have time to give them a pat on the back and say, great job, and make sure that they get the credit, whether it's an email or a nice sticky note, or you do something nice, you take them for lunch. Those are the things that make an incredible big difference. And I'm sure those of you that had great bosses know that those things mean a lot to the folks when they're working really hard, and the appreciation from the senior leadership team is there. So that's really important. And I think it's, given the right credit where credit is due. And we actually have another one coming up November 5th. So Matt and I are going to be here again talking trash about tariffs and trade team tensions. And tariffs could be good or bad, and we're going to tell you what we think about it. Again, there's a lot of mixed results out there in the economy, and we're going to do some analysis and bring that to you so that you can better position your team and your company as we all traverse through these major changes that are happening as part of the latest policies that are in effect.
And Mike, we plan on hitting a number of topics all across the spectrum of the discipline. Hopefully, you found value in it. If you did, please hit the like button out there for us. We'd like to get your comments back as well. And we hope you subscribe. We look to do these on a regular basis, 2 a month. And we'd love to hear what topics are important to you. So we hit them. And at times, Mike, as you said, we may bring in some other folks to do some chatting
Oh,
with us
definitely.
and beat it up. If you have different thoughts, let us know. We'd love to hear from you as well.
Yeah,
And
and if there's a topic they want us to cover or you want us to cover, let us know.
real good.
Pick our
Mike,
brains. That's what
first
we're
month,
here
we
for.
kicked it off. Hey, we hope you enjoyed it. Hope you found that there was value in it again. And don't forget, giving credit is truly where credit is due. And we're hopefully that you're giving credit where it's appropriate. And CRF's here to support you at any time. Thanks, everybody. Mike, great chatting with you. Bye bye.